Let's talk about Warren Buffett. What if I told you that one of the greatest investors in history, maybe the greatest, called a 13.6% gain mediocre? Well, we're going to go back to 1984 to get right inside his head. We're going to use one of his most famous shareholder letters to really pull apart the core principles that built Berkshire Hathaway, a playbook that is just as powerful today as it was back then. So let's set the scene. The year is 1984. Berkshire Hathaway's book value per share, which is just a key way of measuring its net worth, grew by a very impressive $133. Now, for almost any other CEO on the planet, this would be time to pop the champagne, right? A total victory lap. But, well, for Warren Buffett, it was a totally different story. And there it is, right from the man himself, mediocre. That one single word is our key to unlocking his entire philosophy. So the obvious question is, why on earth would he call that result mediocre? Okay, so here's the first huge insight. Buffett's benchmark isn't the S&P 500 or what other people are doing. Nope. He uses a much tougher scorecard. He measures his performance against two things. First, the absolutely massive amount of capital he has to put to work. And second, his own ridiculously high long-term average, which at the time was an insane 22.1% a year. All of a sudden, compared to that, 13.6%, well, it doesn't sound so hot anymore, does it? And this really gets right to the heart of how he thinks. Buffett believes that the accounting number, book value, is just a starting point. It's not the real prize. His real focus is on what he calls intrinsic business value. Think of it like this. It's the actual real-world cash a business is going to spit out over its entire lifetime. It's a living, breathing number, not just some static figure on a page. And that's the number he is completely obsessed with growing. So this brings us to our first major principle. Buy businesses, not stocks. You know, most people think of Buffett as a stock picker, but he sees himself as a business owner. And as we're about to see with the very strange story of the WPPS bonds, sometimes the best business to buy isn't what you'd expect at all. Just look at how he framed this investment. He put $139 million into these bonds from the Washington Public Power Supply System. But instead of seeing it as just a bond, he treated the annual tax-free interest as the earnings of a business he just bought. And those earnings? They came to $22.7 million a year. Do the math. That's a 16.3% return on his capital. It was a better deal than buying any actual company he could find at the time. And this slide perfectly illustrates that mindset shift. A typical investor, they see a bond and they ask, what's the yield? What's the rating? Buffett saw a business with legally guaranteed earnings, and he asked, what's my return on investment? He applied a business owner's logic to a totally different kind of asset. And you know, this all comes straight back to his mentor, the great Ben Graham. This one sentence captures the entire philosophy. Don't speculate on charts. Analyze your investments as if you were buying the entire company, lock, stock, and barrel. Okay, our second principle is just as crucial. Great businesses are totally worthless without great people running them. And there is no better story to illustrate this than Buffett's deal back in 1983 to buy Nebraska Furniture Mart. This part of the story is it's legendary. Buffett bought the business from its founder, Rose Blumkin, or Mrs. B, a Russian immigrant who built a furniture empire, literally from nothing. And get this, there were no accountants, no audits, no inventory checks. Buffett just met with her, decided he trusted her completely, and wrote a check for $55 million based on his judgment of her character. That's it. And this is the punchline. For Buffett, Mrs. B's word, her integrity, was as real and as valuable as his $55 million check. To him, it was an even trade. He just knew that with the Blumkin family in charge, the business was in the absolute best hands possible. So what was the Blumkin family's secret sauce? Well, it was stunningly simple. First, bring incredible energy to everything you do. Second, know exactly what you're good at, your circle of competence. And third, ruthlessly ignore everything that falls outside of it. And tying it all together was the final rule. Just act with absolute integrity with everyone. Mrs. B boiled her entire life's work, her whole philosophy, down to this simple phrase. It's the foundation of a business that earns the trust of its customers and, as a result, earn the trust of Warren Buffett. All right, our third principle tackles a really big topic. What should a company do with its profits? For Buffett, one of the smartest investments a great company can make is in itself, through share repurchases. But, and this is key, only when the price is right.
The logic here is just incredibly powerful. First, the math is just undeniable. If a company's shares are really worth $2, but they're selling for $1 in the market, buying them back is like finding money on the street. It instantly makes every single remaining share more valuable. And second, it's a huge signal of confidence. It tells you management believes their own stock is the best investment they can possibly make.
But Buffett draws a very sharp line in the sand here. He contrasts intelligent, value-creating buybacks with what he calls odious greenmail. Now, that's when some corporate raider buys a chunk of stock, threatens a takeover, and then gets bought out by management at a premium. Buffett sees this for exactly what it is: management using your money, shareholder money, to pay off an extortionist just to save their own jobs.
Okay, moving on to our fourth principle. For this, we have to look right into the heart of Berkshire Hathaway, its insurance business. The lesson here is all about radical transparency, especially when you mess up. So first, a really quick primer on insurance. This combined ratio is a huge metric. Anything over 100 means an insurer is paying out more in claims and expenses than it's bringing in from premiums. And as you can see, by 1984, the entire industry was basically on fire, losing almost 18 cents for every single dollar it took in. It was a disaster.
Now, here's where the candor comes in. In the letter, Buffett just admits it. Straight up. He says that his own company had been consistently underestimating its future losses. The results they'd been reporting were just too optimistic. And he laid out all the numbers, year by year, to show shareholders exactly how big those errors were. And to explain the problem, he used this brilliant and morbidly funny analogy. Admitting your accounting was wrong is like getting a letter that says, "I forgot to tell you, we buried Dad in a rented suit." It's just a shocking, totally memorable way to drive home the point that in the insurance world, the bills just keep coming, long after you think the whole thing is over. And all of this leads to our final, unifying idea, the $1 test. It's Buffett's ultimate rule for judging a CEO, and it answers the single most important question in business. Should a company keep its earnings, or should it pay them out to shareholders? The rule itself is so simple, but it's incredibly profound. For every single dollar of profit a company decides to keep, it absolutely must create at least $1 of new market value for its owners over time. If a manager can't pass that test, they have no business keeping your money. They should give it back. That's it. End of story. And he explains it with another fantastic bond analogy. Let's say your bond pays you 10% when market rates are only 5%. You'd be a fool to take that cash. You'd reinvest every single penny. But if your bond pays 10% when you could go out and get 15% somewhere else, well, you take the cash and you run. Companies should think the exact same way with our earnings. And we'll end with Buffett's final, provocative question. It's really a challenge to every investor and every board member out there. Are the managers of the companies you own passing the $1 test? Because if the earnings have been unwisely retained, it's a pretty good sign that the managers have been too. And that is a thought worth remembering.